It's over. Not in the sense that silver is up again, in the sense that the system's quiet safety valves are getting louder. And when those valves get loud, you don't measure the situation by headlines. You measure it by behavior. Who's borrowing overnight cash? Who's scrambling for collateral? Who is suddenly willing to pay any price just to keep positions alive until tomorrow? Because here's the uncomfortable truth. Markets don't break on the screen first. They break in the plumbing. The screen is the theater. The plumbing is the reality. And right now, silver is doing the one thing that turns plumbing stress into public panic. It's sea climbing, while leverage is already tight. If you've watched silver long enough, you know it doesn't trend politely. It humiliates both sides. It drifts, it bores, it shakes you out, and then it moves in a way that feels illegal. Not because it's illegal, but because it exposes how fragile paper is when people suddenly want the real thing. Today, S-title is IT's S over, banks tap, Fed for billions, as silver shorts implode. And before someone comments fear-mongering, let me frame this like a normal human. Yes, facilities exist for normal reasons. Yes, there are seasonal pressures. Yes, quarter end and year end can create distortions. But normal explanations don't erase the signal. They don't erase the fact that when the private market hesitates, institutions lean on the backstop. And when that happens, while silver is ripping through a key zone, the short side stops being a trade and starts being a survival problem. That's the theme today, survival. Because silver isn't just a metal, it's a stress test for leverage. It's a lie detector for infinite liquidity. And the reason people love silver in calm markets is the same reason people fear it in tense markets. You can print promises, you can't print atoms. Now, I want you to participate right now because your comments tell me which audience I am speaking to. Comment one word, normal or crack? Do you think this is routine system mechanics, or do you think it's a crack showing through the wallpaper? And no matter which side you pick, here's what we're going to do in this video. First, we're going to explain the overnight liquidity world in plain English without the academic jargon. Second, we connect it directly to what happens when silver rips higher: margin, hedging, and forced buying. Third, we talk about the escalation path, the one nobody wants to say out loud. What if this stops being a price story and becomes an availability story? Because once a market becomes an availability story, price becomes secondary. And that is where the panic buying begins, not from retail, but from institutions that cannot afford to be wrong. So here it kicks the cold, open question. If silver holds above this breakout zone and keeps grinding higher, who is forced to blink first? The weak long or the over-leveraged short? In a normal market, you'd say the long. In a tight market, it's the short. And if it's the short, the next move won't be gentle. It will be a step change. Stay with me, because the next part is where we turn the plumbing into a map of the trap. Let's make the plumbing simple. Overnight funding is the heartbeat of modern finance. Banks and major institutions don't operate like a household. They don't have money. They manage flows, cash in, cash out, collateral in, collateral out. And when everything is calm, this flow happens privately, quietly, almost invisibly. But when the system gets tight, something changes. The private market becomes picky. It wants better collateral. It charges more. It lends less. And that's when the backstop becomes attractive. The backstop is basically a place you go when you can't get the same deal, the same certainty from your peers. Again, this can happen for routine reasons, but the key word is certainty. In stress, everyone pays for certainty. Now connect that to silver shorts. A short position in silver is not like a short position in a sleepy stock. Silver is volatile, it gaps, and when it runs, it tends to do it fast. If you're short and price jumps against you, two things happen at once. Your unrealized losses expand and your margin requirement rises. Margin isn't an opinion. Margin is math, enforced automatically. If you don't post it, the system posts it for you by liquidating you. That's the brutality of it. So when silver breaks higher during a period where funding is already sensitive, the short side gets squeezed from both directions. It's like trying to run uphill while the oxygen is being removed from the room. Now add the options market, because this is where the trap gets teeth. When silver pushes into a big psychological zone, call options move in the money. Dealers who sold those calls must hedge. Hedging means buying. Buying pushes price up. That pushes more calls in the money. That forces more hedging. This is a loop. It's not a theory. It is how markets behave when a crowded position flips from comfortable to emergent to urgent. And urgency is the enemy of suppression. Suppression requires patience, coordination, and cheap balance sheet. Urgency destroys all three. That's why the phrase banks panic buy can be real, even if nobody inside the bank wants it to be. The spreadsheet wants it. The risk model demands it. The clearing rules enforce it. And the human being running the desk just tries to survive it. Here, as a key point most people miss, the short side doesn't lose because they are wrong on direction. They lose because they run out of time. Every day they stay short while price rises. They pay in collateral and credibility. Eventually someone upstairs says, "We are not doing this anymore." And when that decision hits, it hits all at once. Shorts don't carefully unwind. They cover into strength. They buy when it hurts. They buy at the worst moment. That's what a squeeze is. It's not a celebration for longs. It's the forced surrender of shorts. So the question is, are we seeing routine funding pressure plus a silver breakout, or are we seeing the beginning of a surrender loop? Comment, surrender or reset. Because if it's surrender, this next part matters. What happens when the paper world is forced to reconcile with the physical world? That's where things get violent. And that's where this story stops being finance content and starts feeling like a thriller. Now we step into the room nobody likes to talk about. Physical reality. Silver is not just a ticker. It's a supply chain input. It's a strategic metal. It has industrial demand that doesn't care about your chart pattern. And the moment the physical market tightens, the paper market loses its magic trick. Because paper markets can expand supply with contracts, but physical markets can't expand supply with feelings. They expand with mining, refining, fabrication, shipping, and time. Time is the key. When demand spikes, the bottleneck is rarely silver on earth. The bottleneck is silver in the right form, in the right place, at the right moment, with the right settlement terms. That's why physical stress shows up as weird little symptoms. Longer delivery windows, higher premiums, products suddenly missing, quotes that come back with limited availability. These symptoms don't always make headlines, but they change behavior. And behavior is what moves price. Here is the psychological flip that creates a true perfect storm. In a normal market, rising price reduces demand. In a stressed strategic market, rising price can increase demand. Why? Because higher price becomes proof of scarcity. People stop thinking expensive. They start thinking running out. And running out is a different emotion. It creates preemptive buying. It creates hoarding. It creates procurement desks saying, order now, deal with the budget later. That's how shortages form in real life. It's not that supply becomes zero. It's that buyers stop behaving rationally because they're reacting to risk, not price. Now imagine you're a big institution sitting short paper silver. Your plan depends on calm. Your plan depends on liquidity. Your plan depends on people selling into rallies. But what if the physical side stops selling? What if the physical side starts pulling metal out of circulation? The paper, short, becomes more dangerous because it's no longer just a P&L line. It becomes a potential delivery headache. And even if most players settle financially, the fear of delivery stress changes the entire landscape. It changes what people are willing to risk. It changes how market makers quote. It changes how aggressively desks will hold short exposure into key dates. This is where tapping backstops becomes interesting. Because liquidity can keep paper positions alive, but it cannot conjure physical supply. That's why the backstop can feel like an answer while also being a confession. It's the system saying, we need cash to manage the risk, but if the real risk is the metal, cash is only a delay button. Now, I want to throw a simple, explosive question into the comments. Do you believe the real battle is investors versus banks, or is it industry versus paper? Comment industry or banks, because if industry is the real buyer, then dips become invitations, not warnings. And that brings us to the next chapter. How the trap turns into a chain reaction, where every attempt to calm the market accidentally makes the market more aggressive. That's the doom loop. And if you understand that loop, you understand why people say it's over. Here's the doom loop in human language. When a system is leveraged, it depends on calm. When calm disappears, the system tries to buy calm. It buys calm with liquidity. It buys calm with backstops. It buys calm with rules and temporary measures, and don't worry, it's under control language. But hard assets don't care about language. Hard assets care about purchasing power. If you add liquidity to calm the system, you may be calming the system in nominal terms while increasing the incentive to own scarce things in real terms. That's the paradox. And silver loves paradox. This is why a lot of people feel like the moment the system steps in, the long thesis gets stronger. Not because stepping in is evil, but because stepping in is inflationary in spirit, even when it's technical in practice. It tells the market one thing. We will not let a disorderly unwind happen. And if you're a short seller, that sounds comforting, until you realize the unwind you're avoiding might be replaced by a slow motion repricing. A slow motion repricing is worse for shorts than a one-day spike because it bleeds you out. It forces you to keep posting collateral day after day. Now, let's talk about what happens above key psychological zones. In this phase, the market becomes reflexive. Price rises. Risk models tighten. Shorts reduce. Dealers hedge. Buying increases. Price rises again. The scary part is that you need a new headline every day to keep it going. The structure keeps it going. This is why some bull moves feel like they have an engine. They do. The engine is positioning plus hedging plus fear. Now, most people watching silver content want a number. What's the target? And I get it, but targets are bait, regimes are truth. If the regime is tight physical, sensitive funding, crowded shorts, then the upside can overshoot and stay elevated longer than logic says it should. In that regime, $5 moves become normal, $10 moves become possible, and the shakeouts become psychological warfare. Because silver will try to throw you off. It will rip, then smash, then rip again. That smash is not proof the bull is dead. Sometimes it's the bull clearing the seats. So if you're trading, your enemy is leverage. If you're hedging, your enemy is hesitation. And I'm going to make you pick again because it matters. Comment, trade-o, or hedge. Because the mistake people make is trying to hedge like a trader and trade like a hedger. That confusion is expensive. Now we're ready for the part that gets everybody arguing. If banks are trapped, why don't they just push it down like before? Maybe they try. But what if they can't push it down without making the physical problem worse? That's the final twist. And it leads directly to the conclusion. The point where the market stops respecting the old playbook. That's part 5. This is the part where we finish the story with a survival map, not a fantasy. If the system is leaning harder on backstops while silver is breaking into a new zone, you should expect 2 things: acceleration and traps. Acceleration because the structure can feed itself. Traps because silver loves to punish both greed and fear. So here's the map. First, expect the last smash. It's almost a ritual. When a market breaks higher and the old guardians feel exposed, they often attempt a sharp drop to scare people out and reset positioning. It's not guaranteed, but it's common. If you see a sudden down spike, the key question isn't, did the bull die? The key question is, did the physical market loosen? If the physical market stays tight, a paper smash is just a discount that increases demand. It's a sale sign on a shelf that's already empty. Second, watch behavior, not talk. In this phase, what matters is whether buyers disappear when price rises. If buyers don't disappear, price must rise until they do. That's how rationing works. Third, understand the difference between price and access. In a normal market, you can always buy at the screen price plus a small spread. In a stressed market, you can't. Access becomes the hidden tax. That hidden tax is what turns X silver into good luck getting it. And that S why people who have lived through real squeezes donitoire obsess over perfect entries. They obsess over being positioned before the doors narrow. Now, let's talk about the emotional trap. This is where most people sabotage themselves. They hold through boredom for months, then sell on the first scary candle because they can't tolerate the volatility they waited for. Silver's job is to make you regret your decisions either way. The only defense is clarity. If you are a trader, define your risk and accept you might miss the top. If you are a hedger, define your purpose and accept volatility as the price of protection. Neither is better. Confusion is the only losing strategy. Now I want to end with a clean comment trigger that also reveals something real. Do you think the next phase is controlled rise or disorderly move? Comment exactly that. Controlled or disorderly. Because if it becomes disorderly, the system's response will be more liquidity, more interventions, more attempts to smooth the curve. And ironically, those attempts can make the hard asset narrative stronger, not weaker. That's the paradox we started with. And that's why the title is It's Over. The old playbook depended on calm. This phase is not calm. The old playbook depended on endless paper supply being enough. This phase is about whether paper can still command physical reality. And when that question enters the room changes. So here's the final sentence I want burned into your mind. In a leveraged system, the crisis is never the first spike. The crisis is the moment the spike forces behavior to change. If the shorts stop pressing and start covering, if the dealers stop fading and start hedging, if the buyers stop negotiating and start securing, then you're not watching a rally. You're watching a regime shift. And regime shifts don't ask for permission. They announce themselves, loudly, in the plumbing first, then on your screen.